Hello traders, welcome back to my channel. You are watching Ali Abbas at the Stock Monger. So today's topic, I would like to talk to you about investments, the ABC of investments. Now many traders, many investors have their own versions. They have different ways of looking at investments. So what are we going to talk about today? A three-step method of how investments should be treated and how you should look at it always in the long term and not in the short term. So let's get started. So investing is basically putting money in, watching it grow, taking it out and using it. But is that the way the investment should actually be treated? What is the current generation looking at from investments? Are they looking to buy a house? Are they looking to buy a car? Will it beat the inflation? Will it sustain their retirement life? So the many things that people would look at, how they plan their goals, how they plan their targets. So the A of investing would be to plant the seed at the right place. By saying that, I mean putting the money in the right place to begin with. Now, you might not be too comfortable with a fixed deposit given the rate of return and it does not beat inflation. So even if you compound it, it takes a lot of time for it to double. It takes about 8 to 9 years for the money to double if you keep compounding the returns with the principal amount. So let's look at other ways of investing. One option would be to invest in ETFs, exchange traded funds. So these are funds which you can see in the stock market. For example, we have Nifty Bs, we have Bank Bs, we have ITBs, and the many other type of ETFs in the stock market available right now. Another option is to look at buying long-term stocks which pay good dividends. And by paying good dividends, I mean the stocks which will give you money as a dividend at the end of each half year or quarter or every year as they operate, and you reinvest that money into the same stock. And if the stock increases in value as well as getting more dividends, then it's a win-win situation. The third way of looking at planting the seed in the right place is to go into long-term stocks which you feel will have a major upside. They may not pay very good dividends, but if you see that the stock has good future to probably double or triple in the long term, those are other investments that you can look at. Choosing the right place to deposit your money is very difficult. That is why you should always consult a financial manager at your bank or at the firm that you're investing in and get some insights about where to actually park your money for a long term. The B of investing is to be patient. Patience gets you returns. We have a problem in today's day and age of people looking for quick money, for quick returns, and they want to put into other places. They want to diversify, but eventually they don't end up diversifying anything. They put their investments, they cash out at small percentages, they compare it to a fixed deposit. That is the biggest mistake that anyone can do. If you are looking to invest, you don't look at the rate of return per year, but you look at the growth opportunities in that investment. Everybody knows the example that is going on social media regarding planting a seed for a bamboo tree for 4 to 5 years. The sapling doesn't do anything, it's still in the ground, but you keep nurturing it, you keep watering it. Then suddenly in a few weeks, it starts to shoot up and goes up 100 feet tall. And then you eventually cut it down and you use that bamboo for other purposes like furniture or whatever you can derive out of the bamboo. Even the mango tree, the mango seeds are planted, a tree comes up from one seed, a tree comes up, that tree gives mangoes, then those mangoes are then harvested and they are sold, and that profit is again reinvested into more planting of mango trees. So this circle keeps going on and on and on. The same way, if you're looking to diversify, you have to see where your money is safe, where your money can give you good growth opportunities, and what do you plan to do with it. Are you looking to compound for better returns in the longer term? Are you looking to shift the investments, because not every mutual fund may operate in a profit? Not every investment may grow as fast as the other. So if you have that opportunity to withdraw and shift the investments, well and good. Now the C of investing. The C of investing is how to treat the returns. Now let's say that you have invested in ETFs when the market crashed, and it's gone up like 20-30%, and then it's slowed down. Now, do you want to hold it in the slowdown, which is not giving you any growth, or do you want to withdraw the profits and invest that somewhere else, keeping the principal intact? An option over here. Option 1 is that you withdraw the principal and let the profit operate on its own and move the principal elsewhere. The other option is that you withdraw the profits and invest those profits somewhere else to grow and let the principal be intact over here. The third option is you split it completely. Suppose, if you put in 10 lakh rupees in the ETFs and they've grown 10%, so now you have 11 lakhs. So you divide it into 5.5, you still leave 5.5 in the ETFs and you remove 5.5 and invest it somewhere else. So now that I have shown you how the ABC of investing happens, understand that these are all long-term methods. If you're looking for anything in the short term, there is no way that investments will double or triple unless you're doing futures and options in the market, which is very high risk. In this day and age where everything is so expensive, the cost of living, the cost of education, the cost of lifestyles is so expensive. If you're looking for good returns to sustain your retirement, you have to be very patient and very calculative with your investments. If you're going to put it into a mutual fund and after a year you realize that, I have some expenses to take care of, I have to do something about this. If you're taking out your investments, then garnering that capital again to invest will take a longer time. So you've foregone your investment returns for that period of time that you've withdrawn it, and then you're accumulating capital, hence losing more time. So that is why if you're investing, be sure to invest something that you can forget for at least a period of 5 to 10 years. That is when the money grows. If you're going to put it in 6 months or a 1 year or a 2 year instrument, it's not going to get you the returns to do something more. Please be sure to like this video, share this video to other people who are looking to learn the ABCs of investing, the basics of investing, and please do subscribe to the channel for more updates and more knowledge sharing. I'll see you in the next video. Thank you.